Coming up today, stocks start the week strong, whilst the media is still negative. Yields bump up, the latest forecast from the New York Fed, AAPL this Wednesday, what's going on with oil, and why robotics stocks are ripping like crazy today. It's going to be a good week, guys. Let's go. And welcome back, optimists, to your favorite financial channel on the entire internet, Click Capital. On a pretty strong start here for the week, except for mega cap tech. Didn't participate in this rally here today. Whilst looking across the rest of the market, was a strong bullish breadth of a day. Pretty much every sector finishing in the green here. And stick with me today because I'm going to give you my opinion on the likelihood of us having seen a bottom in the market last Thursday night, as we just got the first 2 consecutive up days in this entire fast correction. Even though plenty of investors and the market is still on edge here. Fear and greed index still really low here in extreme fear. However, with the last 2 days move, we're getting some good technical signs and seasonality from that. We may have just finished one of the fastest corrections ever, and that's defined by a 10% pullback from all-time highs. Only taking 16 trading days. Just a month ago, we're breaking out to all-time highs, and here we are with the indices down 10, 15, 20%, along with some growth stocks down 30, 40, 50%. However, these sharp fear spikes can often happen in bull markets. Looking back in history, some of the quickest corrections come with the best forward returns. We're higher 100% of the time, 3-6 months time, and have only been lower once in a year from now. And as I noted on Friday's show, we had really good breadth and participation, a breakout on up volume versus down volume, the highest since the bounce back from August last year. We also just had 2 consecutive days with 90% of S&P stocks advancing. Again, looking back in history, this pattern produces really good forward returns. 88% of the time we're higher 3, 6, and 12 months later, and better than average returns for those 12 months as well. Same deal when looking at another similar pattern, when the S&P 500 closes at a 6-month low, then has consecutive 90% up days. In other words, the market's come off and then staging a strong kind of rebound. Looking back in history, we're higher 2 months later, 100% of the time. And again, looking out 3, 6, and 12 months, the odds favor markets being higher going forward from here. But it's been an interesting year so far as we approach the end of Q1 here. Hasn't been a global equity pullback that would suggest an imminent recession. Same goes when looking at global bond yields pushing higher as well. Rather, it's been a sharp underperformance of USD assets in tandem with the weak dollar as well. And what appears to be a big rotation this quarter out of USD assets into European assets, and very strongly so. What you're looking at here is the year-to-date absolute performance in percentage terms in US dollars, with light blue being 1 standard deviation below world market performance, dark blue +1 standard deviation. What we can see is an outperformance in developed European markets, especially industrials, German and French industrials, doing quite well year-to-date, including financials as well. We've also seen Chinese markets perform exceptionally well so far this year, and along with a good start for Brazil, which, as I noted in December last year and coming into this year, had been really oversold. Just looking at the ETF, EWZ, it's got a dividend yield above 7%, leverage to commodities, and could potentially set up for a good performance this year, at least a good diversifier in a portfolio. But again, looking at global stock markets, it's actually been American consumer companies and technology companies that are some of the worst performing year to date. Only other real country that sticks out is India, also weak year to date. And so it's funny, isn't it? This sharp pullback in US stocks so far this year is due to fears over tariff. I believe a lot of it is political pressure from the media that's finding its way into big global institutions as well, betting against the new admin. The fact is, the United States has the lowest tariffs on all of its trading partners than what they have on the States. And no doubt this could take a little while to play out, but wouldn't it be funny if the new admin's approach to reciprocal tariffs actually results in global tariffs coming down? And who knows, maybe this year. They don't just want to bow down straight away to the new admin. They'll probably be politically pressured to eventually come to the table. But imagine all these tariffs got smaller and smaller and smaller and smaller around the world. That would indeed level the playing field for the States and enable their companies to sell more abroad. And I don't know about you, but I think that's bullish. So like I said, if the fundamentals are improving, but we're also getting spikes in volatility, that can present great opportunities. Because sometimes fate loves irony. And wouldn't it be ironic if this whole trade war, increasing tariffs, actually results in global tariffs coming down? And so with this sharp pullback we've had, kind of brought valuations down a bit, back into kind of normal ranges. And I would say actually pretty good considering the momentum in corporate earnings growth. And NASDAQ now at 24 times the next 12 months earnings. And what you're looking at here is the 95th and 5th percentile range of historical valuations looking back 20 years. Got the Russell 2000 right at its 20-year medium, 22 times. The S&P at 20 times, equal weight, 16 times. And the often under-discussed mid-caps actually below their 25th percentile range when it comes to the next 12 months price earnings multiples, and that's because these indices are skewed by mega caps, where the mid caps are not. And you wouldn't think it, but the Russell 2000 has actually gone 839 days since hitting a new all-time high. That's just a few days behind the second longest streak back in the early 2000s, and just a bit over 100 days since the longest ever streak after the GFC. And just looking at a weekly chart of the Russell 2000 here, currently trading at the same price as January 21 over 4 years ago. And in fact, just looking back at the highs from 2018, we're only 18% higher than where the Russell was 7 years ago. If we were to go a bit lower here over the next few months, it's hard to imagine, but the Russell 2000 would actually be approaching lost decade territory. But you see, the longer we consolidate or even pull back on this index, the better the valuation, the better the yield, the better the relative attractiveness of this asset class versus what other options investors have to invest their money. That's why I continue to believe small caps and mid caps, many just regular stocks out there, are still good value, especially in a 3-4% interest rate environment. And so these sharp pullbacks in the market allow patient investors to buy broken stocks, those where the fundamentals are still good, the revenue is still growing, and not broken businesses that deserve to be smashed down. But it's funny because some wait in anticipation for years and years for the next recession. In fact, some even build their whole careers around predicting recession. Always easy, grabbing that headline, getting the attention. Big crash coming, look out. Have looking back in history, it could be a long time between recessions. I wouldn't even really call February 2020 a real recession. Technically it was for 2 months, but the market had one of its sharpest bounces and recoveries ever in that year, thanks to record liquidity and stimulus. Otherwise, like I said, looking back over the last 35 years, we've only really had 3 recessions. And when they come, they generally only last 8 months to a year and a half at the most. But the media, by far and large, is still pushing fear. Why the stock market will keep dropping. Tariffs, recession, stagflation, orange man bad, the list goes on. And in true fashion, a lot of big Wall Street banks also chasing the market, lowering their end of year forecasts for the S&P 500 index. Came into the year pretty hot. Classic herding behavior, recency bias, and chasing the market. Being reactive instead of proactive, like any good investor out there. And so the bulls just can't seem to win either way. If yields go up, we get claims of stagflation. Then the next week yields go down, we start seeing headlines of recession fears. But I believe this time is different when it comes to this new admin. Not really toeing the line, status quo, pretty much being the new president's whole mandate and his entire political career. But like new Treasury Secretary has said, they really want to get rates down to get America's debt under control. The growth in interest repayments now exceeding defense, simply on an unsustainable path. The new admin does need to make Javier Milei style cuts to get this under control. No doubt bringing with it some financial market volatility and getting consumers worried, looking at sentiment and expectation surveys. And according to the Federal Reserve Bank of Atlanta, their latest estimate for first quarter GDP is at negative 2.1%, thanks to a massive front loading on tariffs, record gold imports, and indeed what's likely to be soft Q1 consumer spending. However, if you ask the Federal Reserve Bank of New York, their model has a little different numbers. Their estimate for Q1 this year, 2.69%. And in fact, just looking at Q2 here, they're expecting 2.66%. I think we'll come in a little soft in Q1, but I still expect the US GDP to grow above 2% this year. And I wouldn't be surprised if we finish on a 3 handle either. And I know this is hard to imagine, but like I said, if these tariff negotiations result in a favorable trade deal for the states, like I think they will, and also result in global tariffs coming down as a whole, which I also think will happen, United States GDP could grow 4 even 5% over the coming years. And I know that's hard to imagine for a lot of people, but I wouldn't be surprised if it happens, given the state's leadership in technology, AI, robotics, and like I said, this whole tariff thing could actually result in much more favorable global business condition. But the one thing the market's had to digest is that short-term put is gone. And for those of you who don't know, when we talk about the White House put or a Fed put, that's an analogy for a put option contract, meaning if the market has a sharp correction, pullback, or crash, the White House and the Fed will take some actions, put out a headline to come and save the market, like insurance, a put option. But the new admin, including Treasury Secretary, said they don't mind a little short-term volatility. They're not going to be so sensitive to each day-to-day move in the market. Market wants to pull back 10-20%, no big deal, let it. Like the new Treasury Secretary said, that's completely normal and healthy. What's not normal is government spending and its interest expense going vertical and meddling in everyone's affairs all around the world. And so it will be interesting to hear from Jay Powell this Wednesday. The Fed meets to decide on interest rates, pretty much a lock. They'll keep them on hold. More importantly, will be his language, which I expect him to once again come out and play it safe, walk the line, just say he's looking at the data. It's too early to tell. Got to wait to see how all these tariffs play out. He'll probably talk a little bit about weakness in consumer sentiment, but otherwise the economy, jobs market, business investment, the health of credit markets are all holding up just fine, but it's more this, policy uncertainty. So pretty sure he'll come out and not give any indication of what he's going to do next on rates rather than just reaffirm they're kind of in a wait and hold mode, especially whilst inflation has been coming in good of late. Another big catalyst this week is Nvidia's AI conference for developers. Jensen Huang set to deliver the keynote tomorrow at this event, the GTC conference. Wall Street looking for updates on the rollout of their next generation Blackwell GPU chips, and we've already got robotics stocks catching a strong bid here today, especially one of my favorites, Rich Tech Robotics, a micro cap that offers a range of robots across a wide range of industries. What you're looking at here is their Scorpion bot, the one-armed bartender, where they also recently showcased their products in a European conference, where they're also looking to expand. It was also nice to see them mentioned in an article last week in Forbes, From Kitchen to Table. Robotics is reshaping hospitality, with Forbes basically saying they're revolutionizing the hospitality industry, where Forbes sat down with the president of Rich Tech Robotics and talked about their lineup and potential impact on the hospitality industry. No doubt, still very early days. This is going to take many years to play out in real society before all our bars and cafes are mostly full of these things. However, the stock market is a forward-looking mechanism. In addition, crowd sentiment. And so the market appeared to warm up to Rich Tech today, finishing up 32%, as this stock is likely to remain very volatile for a long time. But like I've been telling you guys, I was taking advantage of that and had been buying the dip over the last couple of weeks. And some of these stocks have just absolutely been smashed down. Serve Robotics, just a little bump up there today. Paladine, Stereo Taxis, Microbot Medical, even some of the biggest robotic stocks out there, Intuitive Surgical, 174 billion market cap. This too's had a sharp 22% pullback from highs. And just looking at the company that's going to make the brains for a lot of these robots, Nvidia, it's actually a little weak today along with the rest of mega cap tech. Thanks to Tesla having a bit of a pullback today, still plenty of volatility in this name as well. Thanks to all the negative headlines and sentiment being pushed by the mainstream media establishment and all the sheeple out there that believe everything that comes out of their TV, once again motivating them to take to the streets to physically attack this brand. But I genuinely think all this Tesla hate will end up being great marketing for the brand and all the eyes and platform it's got as we go into the next stage of this company with robo-taxis and humanoids. I think Tesla lives rent-free in a lot of people's heads. And like the old saying goes, there's no such thing as bad publicity. But technically speaking, we're still yet to confirm a bottom here. We very well may indeed come down and retest this 220, and who knows, may even poke its head below 200, which I would love a chance to pick up a few more shares at 188 if possible over the coming weeks. Because Tesla is still expected to grow earnings next year at the fastest rate in the mega cap tech, second only to Nvidia. No doubt has a lofty PE there. However, like I said, we've got the most amount of catalysts on the horizon that I've ever seen in this company's entire history. I believe it deserves this PE. Plus, I'm not so obsessed about what they're going to make in earnings per share in the next 12 months. I'm kind of more focused on the next 10 years and beyond. But what else really sticks out on this list to me is Nvidia, still expected to grow earnings in excess of 50% next year, whilst they're only on a forward PE of 25, third only to Alphabet and Meta. That's a forward earnings yield of 4%, whilst their company is still revolutionizing the world, not only powering AI data centers, but soon to be powering a lot of robotics as well, which Jensen Huang is excited about. Moving on, another stock catching my eye today, Robinhood, getting into the prediction betting markets just in time for March Madness. And they've really been growing leaps and bounds of late. I believe Robinhood could eventually become one of the biggest global finance companies in the world, because they're not just offering trading stocks and options, getting more into things like fund management, regular savings accounts, now prediction markets, and also offering like 1, 2, 3% matches on customers that will switch over their IRA pension funds to them. Stock having a pretty good technical bounce here today off support levels. And I think a lot of people would be surprised to know that Robinhood has more millennials on their platform than Charles Schwab, Fidelity, E-Trade, and Vanguard combined. Market cap still only 37 billion, which is not even really a large cap speaking these days, especially when comparing more traditional firms like Charles Schwab. 145 billion, and no doubt all that boomer money will last for many more years. But like I said, I think Robinhood's the future, strongly dominating with millennials who have still got many more decades left in them. Also doing well today, China, continuing to come out with new policy aimed at spurring consumption, bringing back capital to the country, and getting underneath their capital markets. Once again, media still not convinced, as are many global investors. But again, just looking at the price action, we actually just took out the highs from the first stimulus back in October on Friday, and another big push up here today. And it was actually back around here where David Tepper, hedge fund billionaire, went on CNBC and said, buy everything, China. We ran up for another week or so, pulled back. Everyone's convinced the tariff, we're going to knock them over. The market's done a bit of a gotcha so far in Q1. And Alibaba, David Tepper's largest position. In his portfolio, it too just broke out to a fresh multi-year high. In fact, almost 4-year high. It just broke out there today. And Baidu as well. After a soft reaction to earnings, even though it came in with a good beat, it's recovered, had a monster day today, up over 9%. Just moving on to commodities. We still got a bit of live action in the Middle East with the Houthis still attacking ships passing through the Red Sea. New president's issued a threat to Iran. They'll be held responsible for any future attacks committed by their proxy groups. And then he's going to be speaking with the leader of Russia tomorrow about potentially ending the war over there. The market's not too really focused on this like it was a few years ago. However, I still think it's a good thing if this gets dialed down, and certainly should deflate the risks of material upsets to the supply of crude. Did get a little bump up there earlier on today, but reversed course. Gold's still sitting pretty at all-time highs, just above 3,000 an ounce. But what's looking good to me is silver for a bit of a catch-up trade, and it's got some momentum here, and especially silver miners looking pretty good on the chart. We'll just look at the weekly on the Global X Silver Miners ETF, SILV. And so like I said, I still believe we could be in the early stages of a secular bull market for precious metals, and especially the miners, which have underperformed for so long here. See, silver miners had a good year last year. Then right now, technically speaking, we could be breaking out of what's been about a 6-month consolidation here. And we could potentially be doing something that ends up looking like this. And so even if growth stocks continue to stay weak and potentially consolidate in Q2, if we don't get that big V-shaped recovery, could actually be the likes of silver miners and some other commodity-related stocks that could be the place to find some fresh growth for our portfolios. My latest stock pick for members was a mining-related company that actually just broke out to brand new all-time highs. And so this is definitely going to be an area of focus for me until growth stocks have proven to find their feet and bounce back. Then if we hit new all-time highs on the indices again, that'll be the green light for me to step on the gas with growth. Until then, I'll be looking to diversify with a big focus on commodity-related stocks. Okay, so back to the market and what I said at the start of this video. What are the chances the market's just put in a bottom and we saw the low on Thursday afternoon there? So we do have a few good things going on here. Like I said, 2 consecutive up days. We haven't seen this entire correction. We are coming into a bit of a bullish seasonal period, second half of March, getting some good signs in terms of advancing issues and up volume versus down volume. Sharp bounce back in stocks above the 20-day average. Sharp fall off in stocks hitting new lows. VIX still a little elevated here above 20. Still a slight bit of backwardation and flatness in the term structure, but the front month VIX futures contract is pretty much sitting right at parity with the second month. And typically when we've had the big spike and it goes back below this, most of the time we've seen the bottom. So the odds have definitely improved a lot today, in my opinion. In addition to my risk on off indicator, continuing to shade the chart green here, along with my S&P 500 oscillator having a really good bounce off those lows from mid last week, currently above 44. And this too, when it goes above 50 after being really oversold, typically confirms the bottom. We got bond yields nice and firm, not suggesting the Fed needs to rush out and cut rates anytime soon. And just looking at the iShares, all world index ETF, basically global stocks, seem to be still holding this technical uptrend, the bull market that started in late 22. Plenty of indices still near their all-time highs. There's a look at the weekly chart, and high yield bonds as well seem to be holding up pretty good here after a little bit of a pullback. And high yield spreads over treasuries did bump up, but off very low levels. Still seem to be in a downtrend. Credit markets just fine. Bitcoin still trying to find its feet here, and the spread of high beta versus low volatility stocks may indeed have made its bottom, as I was suggesting a week ago. Even though the Mag 7 stocks pulled back a little bit today thanks to Tesla, they were still the winner on Friday, up almost 3%. So I still think there's some chance we may come down and retest, but if we were to put in high highs and higher lows tomorrow, those odds would be getting lower and lower, in my opinion. But we still can't say for sure until we really see that crush and volatility getting back into mid-teens and we get more closer to the 50-day VWAP. So no doubt we could have a bit of up down this week. Market might be on pause going into the Fed decision on Wednesday, hearing from Jay Powell. Do like the price action we've been getting in small cap growth, these theme stocks, nuclear, clean energy, batteries, space stocks bouncing back again today. Little mix there in AI and quantum computing. Once again, just ripping out the gate here. Big moves happening in these stocks. I think that's a good sign of some risk on the back of the Nvidia AI conference this week, getting the juices flowing. So we really need to see some follow through, and we haven't seen that really big green candle push up yet. As the last couple of days, we're on a bit of a soft volume bounce here. Also got triple witching this Friday, regular monthly options expiry. Then end of the month and end of the quarter next week could also bring about without big volumes and rebalancing in the market. So to sum it up, I think the odds have improved that we have seen a bottom, but I still have to give reasonable chance we could come down and retest. And any new surprises may indeed bring us down to those lows. However, the market could consolidate and we could form a double bottom, bullish divergences before it finds its feet. Otherwise, by far and large, the fundamentals are still holding up. That's all I got for you today to start the week off. And if you haven't already, subscribe to this channel and I'll keep you updated every day after market close. And a big shout out to everyone who supports this channel by hitting that like button. And as always, you're welcome to share your thoughts below this video in the comments. Otherwise, I'll see you guys again this time tomorrow. Cheers.